I'd like to ask you, Daniel Cocca, what is the biggest risk?
So, I call myself a former lawyer. I guess you're always a lawyer. Risks are near and dear to my heart, right? You'll see 10 pages of risk factors in the documents that we send out. It's something we think about a lot. The oversimplified answer to your question is that we look at deals really with a matrix with two columns. One column is execution. The other column is market-driven appreciation, right? Execution is something that we can mostly control. There are some things like supply chain and whatnot that may fall outside of our control, but usually we can figure out ways to get ahead of the curve on those things. And the partners that we work with, we have zero doubt about their ability to execute. These are not newcomers to the real estate world. These are tried and true groups with long track records of success, right? And so that leaves the other column, the market-driven appreciation. And that's the real unknown. And there are a lot of factors that go into that. But I think in this present moment today, February 2nd, the thing that we're all thinking about is interest rates, right? And, it was a day or two ago that Bank of America shocked the world and said, there's going to be 7 rate hikes this year. And everyone said, what? What's going on over there, right? And it wasn't, though, that long ago, like 4, 5, 6 months where, okay, rates are going to hike up the middle of 2022. Maybe we'll see 1 or 2. And then it was like 3. And then it was like maybe 3 or 4. And so we'll see what happens with interest rates because, as I'm sure your listeners know, the cost of borrowing is a very important component of pricing, whether you're a buyer or a seller, right? And the historical wisdom has been that interest rates and cap rates move together, right? Meaning, interest rates go down, so do cap rates because your cost of borrowing goes down. You can pay more for a property, right? But what we saw in 17, 18, give or take, especially during that period of time where we had 7 rate hikes in 8 quarters, was that really wasn't the case. Rates were going up, but cap rates were still compressing. And I think what a lot of people concluded is that there's a lot of dry powder in real estate right now. Some of that is from the crowdfunding world. A lot of that is from just general real estate private equity that has record amounts of money on the sideline. And so the real question is what will happen once rates really start to tick up? Will you see cap rates start to go up? If that does happen, I actually think it would be a good thing, particularly for folks in our position, because we underwrite pretty heavy cap rate expansion into our deals. If cap rates stay flat or compressed, that means a home run, right? Investors, get a ton of proceeds at exit, right? But it also means it's very challenging to redeploy that capital because pricing is so aggressive. And so there's a happy medium where you're getting really strong returns, but then you also have places to redeploy that capital where it makes sense, right? And what we'll find out over this year is, really what happens to pricing. A lot of the deals that we invest into are, floating rate, variable rate debt, right? And people like that type of debt over agency, government, Freddie, Fannie debt because there are very seldom or very small prepayment penalties, which allow us to exit much faster when you're in a rising price environment, right? But will people then transition to longer term fixed rate agency debt again? Like that's certainly possible. And so it's a long way of saying not just interest rates, but the response to interest rates is, the biggest risk to this space. The worst case scenario, and this isn't a bad worst case scenario, but it is a worst case, is that rates continue to move upward and cap rates stay flat or continue to compress. Because what that means is that when you're buying a 3.5 cap today, you're buying really a 2.5 cap at the end of the year, right? Apples to apples. And so that just starts to get really uncomfortable. There's supposed to be a positive spread between interest rates and cap rates. And so, if you buy it at 2.5 and, you have 4.5 or 5% debt, even a cash flowing deal effectively looks like new construction, right? Because there's no cash flow in the first year or two, and you're basically making a bet on the residual value. And so, long answer to your question, probably not a particularly unique answer, but in this moment in time, February 2nd, 2022, interest rates and pricing response to interest rate change, that's the biggest risk that I see.